What is the ideal trading range for gamma scalping? Have you ever wondered what the perfect trading range is for gamma scalping in options trading? Understanding this can really help you navigate the stock market effectively. Let's break it down. Gamma scalping is a strategy that focuses on maintaining a delta-neutral position. This means that traders buy or sell the underlying stock as its price moves, allowing them to profit from small price changes. To make this work, the underlying asset needs to experience frequent and moderate price fluctuations. The ideal trading range should be wide enough to create significant changes in the options delta. This is important because it prompts traders to make rebalancing trades that can lead to profits. However, the range should not be so volatile that it leads to excessive transaction costs or risks. When we talk about price movement, it is essential that the underlying asset's price moves enough to justify the costs of rehedging. If the price changes are too small or infrequent, the costs of trading can outweigh the potential gains. On the flip side, if the price moves too drastically, the risk of large losses increases, making gamma scalping less effective. Moderate to high volatility is where gamma scalping shines. In these conditions, price swings happen frequently but are not extreme. This means that gamma increases, causing delta to change more rapidly. More opportunities for profitable rebalancing arise in these scenarios. However, extreme volatility can lead to higher risks and costs, which can make the strategy less efficient. Choosing the right options is also key. Traders often opt for at-the-money options or spreads with positive gamma. This helps set up positions that respond well to price changes within a specific range. The strike prices selected help define this effective trading range, as gamma is highest near the strike price. So, what are the characteristics of a practical trading range? It should be narrow enough to allow frequent crossing of delta thresholds, triggering rebalancing trades. It should also avoid large directional trends that could create sustained delta imbalances. The width of the range will depend on how much the underlying asset typically moves in a day and the option's gamma profile. Traders should keep an eye on price movements relative to minimum thresholds that cover transaction costs. In essence, the ideal trading range for gamma scalping is a moderately volatile price, but centered around the option's strike price. This allows the underlying asset to oscillate enough to create meaningful delta changes without generating excessive risk or costs. By understanding these elements, you can better navigate gamma scalping and make more informed trading decisions.